Welcome back to the channel. A lot to unpack, a lot to talk about this week. Bank of Canada hit the pause button again as expected this month. Obviously, this should come as no surprise to many. This was pretty much baked into the cake right now that the Bank of Canada was going to hold. But what we did get from the Bank of Canada is pretty alarming, actually. What we heard, or at least what I interpreted from the Bank of Canada, is it's pretty intense. Obviously, they are using the word of heightened uncertainty multiple times in the press release, obviously talking about too soon to really make a call. As we know, the geopolitical issues in Iran, obviously the oil prices, the Strait of Hormuz, all these things are super important to understand, especially as we approach 2026, 2027, a big year for mortgage renewals for many Canadians, and ultimately where things could be headed, especially for those fixed rate products. So stay tuned. I want to unpack that and more this week. Once again, thanks for stopping by. If you have not yet subscribed to the channel, you want to subscribe, hit that subscribe button, hit the notification bell so you're up to date with everything that's happening in the mortgage marketplace, especially with these Bank of Canada rate announcements. Next one's coming up on April 29th, so make sure you're subscribed, as well as leave your thoughts, questions, and concerns in the comment section below. Like and share the video. Let's get right into it. So earlier this week, on Wednesday, we heard from Governor Tiff Macklem, as well as Deputy Governor Carolyn Rogers, the Governing Council, that they decided to hold the policy rate steady, citing heightened uncertainty with the continued geopolitical pressures that have basically wreaked havoc not only on the bond market, the stock market, and obviously credit spreads. Now, for the sake of argument, we'll be talking a little bit more about the impacts on the mortgage environment in a few minutes at the end of this video. But I think it's super important to understand what this means for Canadians. A lot of people may or may not understand. Obviously, it just harkens back to when I believe it was the Evergrande member a few years ago that basically got lodged in the canal. And obviously, we had all these transitory concerns about shipments, right? Now, with the closure and the basically everything happening in the Strait of Hormuz, if we draw a slight parallel, basically the Bank of Canada is saying that it's possible that we could see obviously a little bit more uncertainty in costs, not only for oil, but other goods that have to pass through that. Now, once again, the governor of the governing council, so the Bank of Canada governor, pointing to the fact that some countries, including Canada, do have some reserves for certain things. So we may not see that that inflation pass through right away. We are expected to see next month of March, the CPI numbers increase. I mean, anybody that's put gas in their car realizes, hey, the price of oil has shot up significantly. And there's some arguments now saying, well, depending on how long this war lasts, how long this closure in the Strait of Hormuz is, and ultimately all these potentials, strategic oil reserves being released, if there's enough to sort of settle or calm down those oil prices, some might see oil prices hitting $200 a barrel. And that single-handedly is not really good news. Now, once again, that's not coming from the Bank of Canada governor, but that's just basically looking at the possibility of, this continued war effort, the continued delay of getting all this passage cleared up. Obviously, the war ended, oil back to normal, because always, as we know, look, oil is great for the Canadian economy, obviously, but for the end consumer, those like you and I who are not related to oil industries, we have to spend our money, right? It's going to cost us more in gas. That means the groceries that we're buying are going to be more expensive. The transportation costs for those items are going to go up. And that obviously is a big no-no for the Bank of Canada. Remember, the Bank of Canada wants to make sure that inflation is basically at its target of 2%. Now, they've cited that, look, CPI, core medium term numbers, they've pulled back over the last few months. So it's positive. We have some room to sort of that bandwidth to play with a little bit. But if we see that get a little bit elevated or it begins to be persistent in the words of the Bank of Canada, then the Bank of Canada is going to have to respond. That means interest rates are going to have to go up. And ultimately, this is a big, big problem. So what does all this, mean for your mortgage? I mean, ultimately, you're like, well, Anthony, the Bank of Canada, as you mentioned, that impacts variable rate mortgages. Lots of Canadians want variables. This is a conversation about whether or not the Bank of Canada has their finger on the scale to sort of move rates up in the next little while. Some economists are arguing that the Bank of Canada needs to lower, especially with that really poor employment number. Obviously, employment hitting 6.7. percent with those 80,000 jobs that we lost. I mean, look, the Bank of Canada said it multiple times. Super important and super clear. The Bank of Canada can't fix the war in Iran in this particular case. We have the global tariffs. We have business sentiment falling apart in this country. We have consumer sentiment falling apart. The housing economy in Canada obviously is pretty much non-existent for the market right now. I mean, we've seen those numbers, and ultimately for mortgages right now, when we look at the mortgages in this particular segment of the video here, it's not looking good. If we continue to see these pressures, man, we've already seen multiple lenders increase those rates, and we were talking about this, just a few short weeks ago. Most of those 3-year fixed were under 4%. Now most of them are over 4%. Those 5-year fixed products for conventional mortgage, not insured mortgages haven't really changed that much yet at the time of filming this video. But I mean, if we can see these continued pressures in the bond market continue to rise, you bet your bottom dollar the banks are going to adjust those rates as they have to, right? I mean, the spreads are not that good. If you're planning a mortgage renewal in the next little while, right? So maybe you're a couple of months out from renewal and you're like, oh my, like what's happening with these rates? Because rates right now are getting higher. We've seen a 0.25% to 30 basis point increase on most of those rates, the 3, the 5-year, even some of the discounts on the variable have disappeared. This is really this dangerous time for renewals, because if you're thinking about renewing, you may want to consider what that cost is to get out of your mortgage a little bit sooner. Maybe there is a slight penalty. Maybe you can renew early with your lender. There could be some options to get into a cheaper mortgage, because the idea here is that, yes, we don't know what the future has in store. Nobody does, right? This war could end in a couple weeks and it's all over. The markets can normalize, or alternatively, this continues on and then the markets normalize. But once again, if we see those increase in prices in oil, that means inflationary fears, the people that move the bond markets, that move fixed rate mortgages, are going to price in that volatility. And that means fixed rate mortgages go up. So you might be looking at the option saying, hey, yes, I have to pay a couple of grand maybe to get out of my mortgage, renew early, look at different lenders, maybe looking at restructuring, financing into a new rate, as opposed to maybe waiting or holding tight and this continues to worsen and interest rates get more expensive. I mean, this is really a cost benefit analysis. You have to run in your budget and say, what do you think is going to happen, right? And what's going to happen with all these particular nuances, especially with CUSMA. These agreements are coming up this summer. If we don't get a favorable deal, is that going to change the business sentiment in Canada? Is that going to drive up inflation? Is it going to worsen the economy here in Canada? Is the Bank of Canada going to be able to lower rates? That's really the question. So I want to just leave the video here. Is if you're approaching mortgage renewal, I know a lot of our clients we're weighing out these options with them in real time. We're saying, hey, look, this is what you could get today. I mean, obviously it's about 10, 15, 25 basis points cheaper, more expensive. It was cheaper about a couple weeks ago. And it continues to worsen. We're starting to get notifications from lenders that, hey, interest rates can go up higher. And if we see oil hit, anything north of $150 a barrel, that could be detrimental to fixed rate mortgages. We could see those fixed rate mortgages retouch 2023 pricing, which could be a 5 or a 6 handle in front of it. And once again, not predicting the future, not trying to scare anybody, but once again, all this uncertainty is super important to understand when it comes to your mortgage. So with that being said, we're going to leave the video here. Make sure you're subscribed to the channel. Next Bank of Canada rate announcement coming up in April. Make sure you're subscribed so you can stay up to date with everything that's happening. But we'll leave the video here. Have a great Friday and an even better weekend ahead. Thanks for watching.